Good afternoon, family. We are back. It's Antoine Smalls with Financial Blueprint. I'm so happy you guys are back with me today. This week was a volatile week. It was so difficult for a lot of investors, for a lot of people on their stock market accounts, their 401ks, right? It's so much that happened this week with the President of the United States, Donald Trump, announcing tariffs across the world. I would say that the trade wars has begun. The trade wars have begun. So, what are we going to discuss today? We're going to have a deep conversation about what these tariffs are. What did Trump do this week on April the 2nd and enforcing tariffs, reciprocal tariffs upon the world, all of these countries around the world, and how that and then impacted the stock market. And Thursday and Friday were two extremely volatile days on the stock market. A lot of people lost a lot of money on their 401ks, retirement accounts, as well as their brokerage accounts. So, and then last but not least, we're going to discuss what should you do moving forward in this economic slowdown, as well as the trade wars that we have going on in your personal life. But most importantly, if you are investing right now, what should you do right now when it comes to your brokerage account, your investment account? We're going to talk about all of these things. First and foremost, we're going to discuss Trump tariffs. So let's get that started. Let's add, this Trump tariff conversation, and let's go.
The U.S. government is poised to shake up global trade in April 2025.
I call it Liberation Day. April 2nd is Liberation Day.
The White House has proposed several kinds of tariffs.
A tariff is a tax on goods as they pass the border. For each instance in which a tariff is put on, it would lead to a price level shift. That shift constitutes inflation.
Economists say the administration's tariff plans could be inflationary. Some are on specific industries like pharmaceuticals and automakers. Others are on entire countries.
They sound very inflationary. It sounds like they're going to jack up prices. The history of tariffs suggests that they generally don't. However, we could be in a whole new ball game here.
Considering what has happened in the past few years, where we had quite some inflation in the US, it's going to be much more difficult this time to pass it through consumers.
That said, tariffs are not the sole cause for concern, according to the U.S. Central Bank, the Federal Reserve.
Trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy.
Are tariffs inflationary?
So we've seen a little bit of what Donald Trump put into the market this week, which he called Liberation Day for the United States. And, from his standpoint, and again, I'm not here to disagree with the president by any means. I'm just trying to explain it so that everyone understands, right? So the United States have been receiving tariffs from other countries when it comes to imports and exports for the last 50 years, right? The United States being the biggest global economy around the world, we buy the most products from countries than anyone else, right? So we import so much, from China, as well as Venezuela, India, and just countries around the world, right? So if it's cars, auto, if it's, tech, when it comes to computer parts, when it comes to engines from Germany, whatever we do when it comes to buying and selling products, we do the most when it comes to our economy. So other countries have been instituting, what they basically is a trade tax on what we buy forever, right? And this has been in Trump's eyes and a lot of people's eyes, being the America being mistreated and taken advantage of. So Donald Trump came in office and said, listen, we've been mistreated for, almost half a century. It's important for us to now, free fair trade to then import tariffs on other countries so that we can then hopefully make deals to lower these numbers when it comes to some of these other countries and the tariffs that they place on the United States. So his goal here is to, hike up the tariffs, hopefully try to get some negotiations from other countries and bring tariffs down from another country standpoint, and then, ultimately create a fair trade throughout the world, right? That's his goal. So he went about doing it in a way that a lot of people don't really think was fair, was he hiked up tariffs at an extremely high level in certain countries, up to 50% in China, for example. In other countries, like I think Vietnam got about like a 70% tariff. But some of these countries cannot be sustainable when it comes to their economy based on those tariff percentages, as well as the United States and our biggest companies in the world like Apple, Microsoft, Nvidia, and other big players. We do so much business in China, in India, in Vietnam, in some of these countries to where these tariffs then affect the business. So, this is now going to affect you and us when it comes to buying cars, for example. If we have a 20% tariffs on Germany or in some of these European countries, then the customer, which is us, will have to then pay for that cost. It's going to be pushed to us. So it's important to understand these dynamics because then affects ultimately what we do moving forward.
Over the first half of the 2020s, the prices that Americans pay for items of all kinds rose at a fast pace. Higher tariff rates could make prices begin to climb again. This happens if businesses mark up their products.
A business markup is the difference between what a business spends and what it asks the consumer to pay. Because most producers and retailers charge a markup, it's really important to take into account how these markups respond to cost changes of imported components.
Businesses have the discretion to absorb those costs or pass them on to consumers.
You have to be aware that if you increase prices, consumers will consume less. We have been in this inflationary environment in the US for a longer period of time, so that the budget of consumer has gone down quite systematically for this kind of spending.
The White House rapidly proposed several tariff rate increases in the spring of 2025. This has led to confusion among a range of business leaders. The oil and gas industry, for example, is feeling pessimistic amid the uncertainty. Automakers have concerns too. Many parts within the vehicles cross borders under past global trade agreements. With tariffs in place, cars assembled in North America could cost $4,000 to $10,000 more.
Even though the American consumer is not necessarily buying this engine themselves, this is still going into the light truck that they are ultimately buying.
What we have seen, for example, is an increased inventory. A lot of cars were sent over the Atlantic and the Pacific pre-Trump, but it means also that you can have a slowdown then in production in these countries afterward.
Higher tariff rates on China, Mexico, and Canada alone could affect consumer prices.
That would add between 0.5 and 0.8 percentage points to core PCE inflation, depending on how you think markups will respond.
If tariffs reach the maximum levels suggested by Trump while campaigning for his second term, it could add up to 2.2 percentage points to core PCE inflation.
So businesses do. So let's take a car, for example. The United States might build the car from a body standpoint within the United States or even within Mexico, for example. But the engine of that car is bought from the European, countries. So although we build the body, we don't actually build the engine or the parts that the engine is needed for, right? So when you take a car to the shop, a lot of times, depending on the type of vehicle that you own, it might take a certain amount of time for those parts to come in because we don't actually build the engines within the United States. So if to do business costs more money overseas, then who's going to pay for that upward price of that vehicle? It's going to be you. Like you will, right? That inflation of that engine or that parts of the vehicle, if it goes up $10,000, you're going to pay the majority of that money when it comes to, the business side. So if I'm GM, for example, I'm not going to eat that cost. It's not going to come into my business and my margin. No, it's going to hit you, right? So the tariffs, in one sense, could be a positive on one side when it comes to how Donald Trump is thinking about, how it affects world trade as a whole. But then on the other side, from a consumer standpoint, short term, it's going to be inflationary when it comes to how much things will be more expensive, right? So buying a car in about a couple of weeks might be $5,000 to $10,000 more expensive than it would have been just shortly 2 weeks ago.
In a statement to CNBC, a White House economic advisor said that tariffs from Trump's first term made no meaningful contributions to inflation. He added that foreign suppliers will have to eat the economic burden.
I think the odds are very high right now that we have not seen the last of the tariff proposals. He likes to use things as bargaining chips. And what he will do is start at the most extreme position and work his way in. The last thing Trump or any other president wants to do is to oversee a recession. If it's indicated that tariffs are going to cause a recession, he's certainly going to back down on that.
If tariff rates do rise, prices for products may cost more, even those made in the US.
For example, the clothes that you consume are imported. You also consume products that are made in America that also use imported components.
As a result, physical items, including pharmaceutical and medical products, new cars, clothes, and homes, could become more expensive.
Oh, let's look at this list real quick, right? So we talking about pharmaceuticals is our highest imported product. Or we just talked about the motor vehicles when it comes to our cars. And if you just look down this list, this is all inflationary items that could go up in price due to the tariffs and due to business and trade being more expensive. All right, just take a quick second and look at it, because this affects you on a daily basis. What are we buying that's going to be more expensive, and are we prepared for that? Right? And we're going to move forward and look at how we need to move forward when it comes to this time and how we can be successful in this period. Because my thing is this: we understand the variables at play. How do we win? I'm all about winning. I don't have anything in me to start talking about losing. I don't lose in anything. So I need to understand the information. We need to understand information so that we can then plan forward to understand, okay, this is what's happening right now. It's not going to change, at least not for the foreseeable future. The policies that's being implemented is going to be inflationary. Products and things and services possibly could be more expensive. How do we make the adjustments to succeed and to progress when it comes to our finances moving forward? That's the conversation. All of this extra stuff that I see on social media, all the complaining, all of the, like calling people names, and it don't benefit you. There's nothing that is going to help you when it comes to that. So why waste your time? That's just not something I personally am going to do. So my biggest thing right now is understand the information, understand the variables at play, make a plan, and execute so that 1, 2, 3, 5 years from now, you will be in a much more successful position because of what is happening right now. We're going to get to the stock market in a second, but that will help you become more wealthy long term. Right. So let's jump to that. Let's jump to the market and let's get to that conversation about what happened this week when it came to the stock market and how that can be a benefit to you, even though there is a lot of people right now that has lost a ton of money. Let's get there. So let's talk about the stock market real quick.
President Trump says the markets are going to boom. Well, that's one word to describe what happened on Wall Street today. He also said his tariff rollout that happened yesterday is going, quote, well. That upbeat assessment comes less than 24 hours after the president, let us say, upended just about 100 years of understood global commerce. Today, Wall Street experienced the worst day since 2020, the post-election boom that the president when he was president-elect, pointed to, well, that's been erased. Stock prices down, and Americans with portfolios, either for their retirement or for now, are facing genuine losses and the unhappy reality that they may be financially worse off than they were before Election Day. Tariffs, of course, are trade taxes, and the wide-reaching effect of them sent shockwaves across the world. Stock markets in Beijing and Tokyo sank to multi-month lows. Foreign leaders lined up to condemn President Trump's actions, promising countermeasures of their own. J.P. Morgan, for what it's worth, warns the president's tariffs could push the United States and quite possibly the rest of the global economy into recession. Despite all of this uncertainty, the president's Commerce Secretary, Howard Lutnick, sounded positive.
When the biggest economy in the world says, I don't like the way you're treating us, how about a little respect? Let the deal maker make his deals. Let the best negotiator and the best person who cares about America, let him make the deals.
Okay, so let's discuss that real quick. So you got two sides of the coin here. You have the business owners, CEOs, economists, leaders in different countries that really don't like what the president did last week, right? So many people totally disagree, right? And the stock market then crashed, or the stock market had a correction that we haven't seen since the 2020 pandemic. We haven't seen a stock market crash on a 2-day period like we did in 2020. And most people believe that it was we self-inflicted on ourselves based on what Donald Trump did on April the 2nd. So when you talk about wealth and the stock markets, as well as 401ks and things like that, these are people's money on a daily basis that's being moved up or down. And on average, we know, again, factually stated, on average, the stock market goes up 8 to 10%, if not 8 to 12% on average over the last 50 years. So there's a lot of wealthy individuals that ultimately put their money in the market to then accumulate that 8 to 10 to 12% annually, because we know that is, especially in the United States, it's almost a certainty that the stock market will go up each year based on the economy, how strong we are when it comes to buying and selling things, and just the amount of money that circulates throughout the United States economy on a yearly basis, right? But what happened last week was the president put a whole like a straight knife into it, and the market dropped significantly. It's a lot of people that got money that's not happy, right? And then you have the other side of the coin, where the optimistic person would say, well, this is a negotiation tactic. We got to allow the president to do his job when it comes to creating a fair trade, a world of fair trade, and not allowing other countries to take advantage of us that like they've had over the last 50 or so years. And we are in a situation where the president is trying to basically repair that. There's many people that don't agree with it, because they feel as though what's not broken, don't fix it. There's no point in doing it, because we still good, regardless of if a country is taking advantage of us like China or other countries like that. It doesn't matter. We're strong. It don't matter. We're going to just keep doing what we've been doing for the last 50 years. But Trump's coming in and saying, no, we don't. We're not doing that no more. And we're going to make an adjustment, and we're going to tear this thing down. We're going to burn the house down, and then we're going to build it back up.
Jang joins me from Doral, Florida. Caitlin Huey Burns is on Capitol Hill, but I want to start tonight with our Money Watch correspondent, Kelly O'Grady in New York. Kelly, as you know, there is a wag or two on Wall Street. Not many, but there are a few. And I heard one today say, well, if yesterday was Liberation Day, today was Liquidation Day. Lots of people selling off on the market.
Yeah, maybe not the best branding that you want to have if you're in the market right now. But yeah, look, you hit on it. I mean, this was the worst day a single day for all of the major indexes since 2020. And what was that, right? That was COVID. So investors were looking at the potential impacts of tariffs, and they felt somewhat similarly to what was happening during COVID. I want to zero in on the S&P 500. So it lost, as you see there on the screen, nearly 5%. But in terms of value, it was nearly $2 trillion. Half of that came from those 7 big tech stocks we've talked about before, Magnificent Seven, Nvidia, Meta, Apple, etc. I highlight the S&P 500 because tech drives so much of it. And that is why if you're looking at your 401k today, it's not looking great, because a lot of our 401ks are invested in funds that track the S&P 500. So a lot of investors said, look, tech is reliant on production in China, and that translated into losses for your 401k today.
And Kelly, what is the sense of prices as Americans try to process this, whether it's for items like furniture or items like clothing or things that they get at the grocery store?
Well, a lot of things are going to go up. I mean, look around in terms of what you're wearing, what's in your home. Most of what we buy is made elsewhere. And so in terms of what you're going to see in terms of price increases, electronics, TVs, phones, food at the grocery store, maybe not as much if Canada and Mexico had been a part of yesterday's reciprocal tariffs, but we do get produce from South America and food items from other countries across the ocean. In terms of how long, it's really going to depend on the industry. A lot of companies stocked up ahead of time, but for those perishable things and things that are coming across the border, you're going to see an immediate increase.
Kelly O'Grady, always a pleasure. Thanks so very much. Weijia Jiang joins me now from Doral, Florida. And Weijia, as you know, the president landed there recently, and he made some news on the plane, as he frequently does, engaging with reporters. And a couple of quotes jumped out at me. The operation is over, the president said. Let it settle in. But then he also said, tariffs give us great power to negotiate. Now they, meaning trading partners, to be affected by these tariffs, will do anything for us. So if the operation is over, are we still negotiating?
So we have two different thoughts right now. We have one thought is the president is using tariffs to negotiate with other countries. That's the one thought. And that is what most people are hoping, right? We hope that the president is using tariffs to negotiate with other countries to lower their tariffs down so that we can positively then lower ours and create a more fair trade agreement amongst countries. The other side of it is there's a possibility that this is not a negotiation tool. And the president is using tariffs to bring billions and billions of dollars within the United States when it comes to business around the world to then help our debt ceiling and our national debt crisis that we have right now when it comes to the United States, right? And then on the other side, lowering taxes to help the United States American citizen, while bringing money in when it comes to these tariffs. So the problem with the second point of just keeping tariffs on, that it then it affects business at a high level, which then affects the stock market at a high level. And a lot of people don't really appreciate the fact that their money is going down when they feel as though it's not needed. So do I believe that the president, as a businessman, is using tariffs to negotiate with other countries? Absolutely. I do. I absolutely believe that. Venezuela already came back. I'm sorry, not Venezuela. Vietnam already came back and said that they will agree to bring their tariff number down to 0 if the United States agrees to then lower the tariff that was just placed on the country just a few days ago. Right. So we have the deal making that has been started between countries that cannot sustain themselves with tariffs over 20 to 30 to 40%. Right. The president knew that there are, economies around the world in these countries that just can't sustain themselves because they don't have the power and and the backing of what the United States has when it comes to how to be sustainable when it comes to tariffs. So I do believe that he will use it as a negotiating tool. The other side of the coin is, does he take it fully off? I don't think so either. Right? He said universal tariffs of 10% around the world. So that is not going to change according to him. Now, again, will he adjust that? Who knows? But for right now, what we see currently is we got universal tariffs across the board at 10%. We got additional tariffs upon other countries like China, and other countries that we do, business with. And we feel like they've taken advantage of us. And, this is our new normal, right? So inflation will go up, right? The prices of goods will go up. The prices of, autos, buying a car will go up. And it's important to understand these things so that we can prepare for what's to come, right? We're going to sit for a second and I'm going to show y'all a chart, because as things go down and as pain happens and fear happens, I look at it from an opportunity perspective. And we're going to move to what we need to do moving forward so that we can, be successful long term and take advantage of these opportunities. Right? Not everything is doom and gloom. Not everything is an issue when it comes to being successful in hard times, but we have to have, an understanding of what those things look like, so then we can propel ourselves forward when it comes to investing, right? So what I'm going to show now is a chart of the S&P 500, which is the stock market, the 500 companies within the United States stock market. And we're going to see the impact of what just happened this past week. So this is the S&P 500 index, right? SPX. This is what happened on Friday. We were down 5%, almost 6% on the S&P 500. If you look at this chart, which is a 5-year chart, and it shows the growth of the market over the last 5 years. And this is down at the bottom. Let me move my cursor for a second. Where we at? There we go. Down at the bottom, we were in 2020. We were at the bottom to the right. And as you move up to the left, to the left, if you move up to the right, you see this huge gap down from the highs all the way down to where we currently sit at in the middle of that yellow and red line. The yellow line is the 72-day moving average. The red line is the 200-day moving average, right? And as you look at the market and look at those lines from a technical standpoint, we hit the red line, what year was that? That's 2022. And we have been moving up since, and we have not come back down to hit that red line since 2022, right? So right now, we could come down to see that 200-day moving average again. We could. We have a couple different resistance lines and support lines that we need to go through. There's a lot of levels that we might hit before that, but this is an opportunity. I don't look at this as a negative thing. I say to myself, listen, I'm 34. I'm going to be investing for the next 30, 40 to 50 years. And my goal in the end is to then invest for my children and hopefully, God willing, my grandchildren. So if I know that I got a huge gap down when it comes to the stock market and I'm getting in, Nvidia at $94 a share when it was just at 140 about a month or so ago, right? And Apple is sitting at 190 something. It was just $240 a share. Microsoft was at $450 a share. It is all the way down to 370, 380 currently right now. This is an opportunity. You do not get many opportunities in your lifetime to see a market that dips 10 to 15%. And it's possibly going to dip more as we continue to see more inflation, a possible recession, and these tariffs, global tariffs out of this world going crazy. So if you just look at these lines and you look at the technicals and say, listen, in a 5-year span, the S&P only came down one time to hit that 200-day moving average, even as low as that 72-day moving average, the yellow line. This is an opportunity to grow wealth and grow money long term, as long as we stay consistent and have an understanding when it comes to the stock market. Right? On Friday, when I seen dips with Nvidia and it got under $100 a share and it went to that $94, $95 range, I just bought. I started to buy. Right? I understand that Nvidia is one of the most important companies in the world. And when it comes to artificial intelligence, semiconductors, chips, AI as a whole, and then the future of quantum computing, I just know that Nvidia is one of the most important companies in the world. And with me knowing this and knowing that I'm going to be investing in this company for at least 10 years, why would I not buy it at a discount of over 30%? Why would we not do that? Sure, there are people that's running away. They are selling and selling and selling and selling. Hey, Warren Buffett has a quote. He says, buy when others are fearful and sell when others are greedy. Basically meaning that when people run and people are fearful of what's happening and you got selling and selling and selling, he says that is when you buy. You don't wait until the market is going crazy up and now you're a part of FOMO, right? Fear of missing out. And now you're just buying and buying and buying at high prices. No, when you see dips of 20, 30, 40, 50% discounts, you take advantage of those opportunities, right? So over the next 30 days, right? Next week, 2 weeks from now, month, we going to see continued opportunities to be able to invest in the market. And I wanted to show this chart because it gives you a visible understanding of the technicals. And I didn't get into all of the different things. I just gave you a basic chart with 2 lines, right? There are way more that I can add to this chart. But as you can see over a 5-year period, we've only come down to touch or even get close to touching that 200-day red line, 200-day moving average one time. And if you look at the chart and you see the free fall that's happening right now, next week is going to be tough, right? Earnings season for these companies is starting actually next Friday with the banks, right? You have opportunities to get into these companies, to start an entry in some of these companies at a significantly lower price, right? So let's have a quick conversation about what the next steps look like. What is the next steps? First, I started my channel and I started talking about fundamental finances. The first thing that we discussed was debt. Get rid of the debt, right? We have to have a better understanding of consumer debt, more discipline, and better decision making when it comes to how much money we actually have versus how much credit we want to use, right? So get rid of the debt. That's number one, right? If you can pay off your car, you can pay off your student loans. If you can pay off your credit cards, your personal loans, do the work to pay off your debt, right? Number two, cut on your unnecessary spending and build a successful budget. Again, we talked about this when it comes to the channel. We started the budget conversation. It is so key for you to have a successful budget and for you to know where your money is going every month, right? Cut on some of the subscriptions that you don't use. Cut on, in some cases, cut on going out to eat, right? Cut on, spending money on some of these clothes, some of these sneakers that you don't really need. As we see more inflation when it comes to different products, you don't need a new car. You don't. You're going to pay $50,000, $60,000, $70,000 on a car and then have a $700, $800 car note. That's insane. That's insane. No, we're not doing that, right? That is being more disciplined and more conscientious of an understanding of what is good debt and what's not. Right. And then last but not least, you need to invest as much as you possibly can during this time. All of my 20, 30, 40, 50-year-old, if you invest in for more than 10 to 15 years, if you invest in for more than 5 years, I mean, I would say pour in. Will there be downturns? Absolutely. Is there fear in the market right now? Absolutely. Is there going to be stocks that's going to be at a discount next week, next month? Absolutely. You will have opportunities to get into great companies at great prices. There is no better way to invest. It's to find a great company at a great price, per Mr. Warren Buffett. Right? So if you missed out on Nvidia's climb about 2 years ago, this is an opportunity to get into one of the best companies in the world. If you missed out on Microsoft moving as it's moved over the last 5 years, you have an opportunity to get into one of the best companies in the world. If you want to take the safe route and go into ETFs, the Qs, VTI, VEO, and you want to invest into total stock market ETFs, as well as industries like technology, SMH, QQQ, right? If you want to get into the VTI, VEO, great companies when it comes to the total stock market index. If you want to get into fixed income, if you want to get into huge dips in the market, you see value in great companies, you take advantage of those things and you jump in now. Open up that brokerage account if you don't have one. Right? If you have a 401k, I would argue that you got to continue to invest more. Raise that percentage, because what we don't understand is, sure, you took a dip last week and you see red. I understand, right? The other side of that is that if you invest more now and you accumulate more of those shares now when it comes to your 401k, that's going to then propel you and help you ultimately in the future. If you sell, you not only hit the sell button, you process that transaction, you got to pay the IRS. You got to pay the IRS for the money that you made on every transaction, right? Capital gains tax. And we're having a tax conversation. It's layers to this. Invest more. Dollar cost average, right? Lower your cost per share. Gain more shares so that when it then goes back up, you make more money. So again, what should we do now? Market is red. Everyone's tripping, fearful, right? Companies, countries, businesses, CEOs, everyone is pissed. Investors pissed. Pay off your debt. Understand that there will be inflationary things within, buying goods and services, right? Understand your budget. If you can cut costs on certain things, if you can lower the cost, hey, take away some things, stop spending money in certain ways. That's ultimately most important. And then last but not least, invest more, pour in more. Last week, I put thousands and thousands of dollars to work. Bought a lot of shares of company. I'm gonna just leave it at that. Bought a lot of great businesses at huge discounts. I bought ETFs at huge discounts because this outlook is 10, 20, 30 years. We're not investing for tomorrow. We're investing for the future. If you have your children's account, pour into it. Continue to invest into it. And you will see it. You will see the future in a bright way, because this is a temporary setback. It's a temporary setback, right? So again, I encourage you guys, man, to not get so emotional about your investing journey. It is all based on a level of understanding. Again, we talked about reading, the importance of it, progressing yourself forward when it comes to, your individual finances, cutting your spending, investing more, learning more, and ultimately putting yourself in a position to be successful. We're going to end with this. My book of the day is my guys, man. You deserve to be rich. You deserve to be rich by Rashad and Troy with Earn Your Leisure. And I'm actually wearing their hoodie right now, assets over liabilities, because we having this discussion right now, and that's the honest truth of it all. It's better to own assets. It's better to own assets over liabilities. You deserve to be rich. And my guys, man, let me just say that I appreciate Earn Your Leisure. I appreciate the guys that I've been around, that's been in my life. I've been to Invest Fest. I have been, in the earners community, as well as Red Panda with Ian Dunlap, the master investor. The love and the appreciation that I have for the people out here that's putting in the work, that's spreading information, that's encouraging others to spread more information and give love when love is due, right? And credit when credit is due. They deserve it at its highest level. Right? So again, tariffs, President of the United States, countries around the world, the trade war has begun. Secondly, the stock market has been impacted significantly in a negative way. And third but not least, what can you do moving forward in this environment? One, pay off your debt. Pay it off. Get rid of it as quickly as you possibly can. It'll free up more money for you to have in your budget. Number two, right? Have a successful budget, plan accordingly, cut spending if needed. And last but not least, number three, invest. Learn more, read more, get around people that can influence you in a positive way for your future, that can give you the game, that can teach you things, right? And let's continue to progress on our financial journey and our financial future. I appreciate you guys. Keep tapping in with me. Again, subscribe to the channel, hit the like button, share the content, leave me a comment. What do you think about the tariff situation? What are you currently doing? What stocks are you currently buying? How are you preparing yourself for the current environment, as well as setting yourself up for the future? I appreciate you guys. Peace.